So James, thank you for that. James is asking about a debit spread. He says, suppose I put on a trade and I want to roll it. Will it compute the break even for the full trade? Yes, you can do that in the profit and loss chart. And if you record it in the portfolio, it will change your effective cost per share of your initial position. So what do I mean by that? I'm going to enter a bull call debit spread. Okay, we're going to use BERY. It's just one of the stocks I'm in that had a move upwards today. It's going to put this in July there, James. But I'm going to buy the 62.50 call and sell the 65 call. But I'm not going to use those prices. I'm going to say I did this sort of out of the money 62.65 call when Barry was at about $63 a couple days ago, maybe on the 15th. And we're going to put it in as a sort of an out of the money bull call debit spread, James, to where we would have had almost a 1-to-1 risk reward ratio. So it's a 250 spread. So I'm going to put in that I got $1.50 here and I paid 25 cents here. The prices would be vastly different. What I'm trying to simulate is a 125 debit on an out of the money spread that's now not near full success, but it's now gone in the money. Okay, so we've got a gain on the position here, about $295 of the 375 expected. Right, I'm sorry. Okay, so oh, I'm sorry. I did a credit. James, I am sorry. I'm so used to entering bull put credit spreads that I put the bull call debit spread in as a credit. Let me edit that. Let's change that up, shall we? This is 150. And this is 25, the out of the money. Better. All right, so I'm not near as much profit as I want, but I've got a 36% profit on this position, James, and I want to shift it to a further out of the money. In that case, there as well. So what I want to do, I'm going to roll each individual leg. We're going to go up to the, I'm just going to keep in July, James, okay? Now remember, the original position was a debit of $1.50. I'm sorry, $1.25. And right now we've got a profit of about $45 or 36%. If we hold it open, which I'd probably do longer to get the time value, to be closer to the full profit of 125 on the position. Now I don't have this one doesn't allow you to roll the whole spread, but what I am going to do is roll each individual leg. So we're going to roll the short call first, and we're going to buy it back, and we're going to roll to the, yeah, I'm going to go August. I'm going to go up to the 67.50 for 205, almost a wash, but 2 points of a higher spread. You wouldn't do this roll, I understand it, James, but not kind of a roll you do. And now it counts as a calendar spread at this moment, so we're going to roll this one up to the August 65. At 410. Okay. All right. So I just rolled a 62.50, 65 spread on Barry up to 65, 67.5. Notice this number here, James, the effective cost per share of 445. What's that reflecting? That's actually reflecting the new cost of 410 here for this position. It would have subtracted, actually should have subtracted the profit off of it based on the rolls, but I think the roll, since this one wasn't a positive roll in that case, rolling it actually increased the value by 35 cents, which you probably wouldn't have done, as I mentioned. But now what happens? So when I go to the profit and loss chart or analyze it, it's basing on the effective cost per share for any position, James, I have rolled before. And I have my new break even here at 67.40 for this particular position, because we moved the strikes up in that case. So my new break even is 67.40. Why is it at 67.40 and not way up here? Well, again, it's because we need to get, if the stock was trading at 67.40, we'd have the cost basis on that position to equal the net price that we need. So as you roll positions, adjust positions in the portfolio, James, it'll show you the new break even. Now, in some strategies, some credit spreads, you'll see rollout opportunities. In covered calls, you can analyze the rollout opportunities, and it'll show you, it'll do the math for you. If I was rolling a covered call with the new percent if assigned to be new downside protection, I'd see the new max risk on the position in that case as well, if it was a married put. And you may see rollout opportunities for your long calls, straddle positions, as we mentioned, and try to think of long calls, long puts, of course. Calendar spreads, you'll see some rollout opportunities. There are some for credit spreads, and there might be one or two that appear for debit spreads, but you might not see them in the portfolio as rollout opportunities that often. So sticking with Barry, let's go back and let's keep that 62.50, 65. I'm going to go back to the original position where we bought this for 150 and we sold this for 25. All right. Now I can do it manually here. Let's say I wanted to go out to September now. I want to see if I can get more premium rolling this position out to December. What I have to do first on the custom spread or the profit and loss chart, James, is simulate closing the positions first. So I just add those back in. I'm looking at my spread down here. Here's my nice little graph. I know that I did something wrong, that I didn't sell this. I apologize, folks. There we go. All right. So here's our bull call debit spread. It's still got too much time value left. I should have used something that had a weekly that expired today for this example, but that's okay. Now, I want to roll this forward, but instead I think I'm going to roll to September instead of that August one we just put in by rolling each leg in the portfolio, but it did show you that it's going to keep track of the different changes that you make. But we have to simulate in this tool buying it back first. So it shows me these both have been added, James, so I'm going to click them again. It doesn't show me it's added twice, but now it does show me that they're down here below. So we just have to do the opposite action. If I bought the 62.5 call, I'm going to simulate selling it. And of course, we sold the 65 call, so I have to simulate buying it. Now what this does is this gives me the total cost of the position, a credit of 45 cents. All right. That's what we were talking about with the profit we had in the liquidation value back on the portfolio. Now, what I can do is that I know my gain on the position, my locked-in profit from closing this particular spread. I could add the September position I want right in now. Let's go higher. Let's go 65, 67.5. I was going to go 65.70, but that's okay. Yeah, I'm going to go 65.70. I'm sorry. Now, if I submit this, so what am I doing? I simulated just closing it, but this tool, James, doesn't know that that's a close. It is technically reading that we are both long and short a 62.5 call for July, and we're long and short a 65 call for July as well. It doesn't know that it's a close. This is just a way to build positions on a P&L chart. So if I submit now the September series, I know the net debit's only going to be $1.85. That's taking into account all 4 previous transactions and the 45 cents, plus this new net debit of 420 minus 190, which would be 230, minus the 45 cents. And so I know what my break even would be 64.55 on this new position. However, that's not reading it correctly, because as you can see, what this is reading is that you actually have 4 legs open in July and 2 legs open in September. So it's sort of doing a calendar type of spread position with multiple legs, and it's showing our return on July expiration or at the halfway point, not on September, because it only reads the closest option. So now that I know what my debit would be after all these adjustments, just fake a little bit of numbers here. We're going to clear out the other 4, and we're just going to increase this by 45 cents. Right? That would put us at 235. That's going to reflect the profit that we took from closing the other position. So my new September spread would be September 65 call at 420, September 70 call sell to open 235, including the 45 cent premium. There I am at 185. My break even 66.85 on the position. Yes, I need a long way to go. But again, this is not quite a 2-to-1 risk-reward ratio. It's sort of looking at a 1-to-2 risk-reward ratio. We have the potential to make twice as much as we're risking for this out-of-the-money debit spread 60 days away or so. That's how I'd use the tools to simulate that. But yes, if you're tracking those in the portfolio, you'll see the new effective cost per share, and that will be reflected in the profit and loss chart as you go forward. But you can just use the profit and loss chart to simulate the roll beforehand, but clear out the legs. So you only have the one expiration that you're looking to roll to, so you're not looking at sort of a calendar calculation between the different options there as well, James. And you'll have your profit and loss chart, your new risk, new break even as well, calculated on the graph for you. Okay, and James, does Power Options, does this work on futures options or just stocks? We only track the options for the optionable stocks, indexes, and ETFs in the U.S. market on Power Options. We do not have a data feed for futures contracts, James, at this time. And I don't know if we're planning on doing that anytime soon. So it's just for the optionable stocks, indexes, and ETFs as well. All right. Well, ladies and gentlemen, we are at 5:45 p.m. Eastern Time. If anyone has any last-minute questions, you can go ahead and send those in. But I just want to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Now, any stocks or options discussed today should not be taken as direct recommendations or trading suggestions. As I mentioned, I'm not opening a bear call spread on DKNG. And of course, I'm not going to do a bull call debit spread on Barry. In that case, those are just for examples. Options involve risk and may not be suitable for all investors. Now, today we had the chance to look at some differences between the sample searches and search criteria settings in the long call field, and in some of the other strategies. We adjusted some of the criteria using the search tool for identifying that deep in the money covered call position or deep out in time covered call position for QTOB. And of course, we looked at the portfolio, the profit and loss chart, and the insurance tool. Well, if you'd like to see any of these tools work for you, remember you can take your 14-day free trial at any time. Just go to PowerOp.com, put in your name and email address, and you'll have full access to the site for 14 days, no credit card required. After that, the subscription levels only start at $45 per month. The delayed service is the most popular level of service at $65 per month, gives you access to all the tools with 15 to 20 minute delayed data. And of course, we do offer a real-time service and further historical tool access going back several years to backtest the different search criteria you may create, historical options chains. So we talked for QTOB as well about going into the YouTube channel and screening specifically for that covered call approach, far out in time, far in the money, the simulated CD discussion. But you can go to YouTube at any time and search across our videos. Just search for covered call, long call. You can search for earnings plays or straddle positions, for example, some of the ideas we discussed today. And of course, you can always go to our archived page, powerop.com/webinars.asp, or just click the free webinars tab when you're logged into your Power Options account. And of course, I just want to remind everyone, I didn't see any last minute questions come in. If you do think of any questions later on this weekend, you can send us an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, trial members and subscribers, remember you can schedule a coaching session at any time. That's essentially a 35 to 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site and answer any questions that you have, as we kind of do today. It's essentially that, but it's just a one-on-one phone call with your questions, or if you say, how can I use these tools? Ernie and I, or one of the other staff members, of course, will walk you through it.